3 weeks ago, South Korea boasted the best-performing stock market on the planet. Their main index, the Kospi, had surged nearly 200% in a single year. This chart shows the exponential climb of that index, but the real story is in these two massive upward spikes. Investors banking on AI memory chip giants, Samsung and SK Hynix, saw staggering 10 times returns. Then, in just 21 days, the bottom fell out. The entire market plummeted 25%, violently wiping out a year's worth of gains in a near-vertical drop. The fallout was devastating. 1.2 million retail accounts were hit, and over 3 trillion won in investments were forcibly liquidated by brokers. Overnight, 1 in every 30 people in the country watched their savings vanish. This isolated collapse in Asia is actually a mathematical certainty driven by a specific financial setup. Right now, the United States is running the exact same playbook, making the South Korean crash a real-time preview of what threatens the U.S. market. To understand how this happened, you have to look at the economic pressure cooker young Koreans face. Homeownership has become so staggeringly expensive that a whole generation felt locked out of traditional wealth building. 14 million everyday people turned to the stock market as their only realistic lifeline. Because they all wanted maximum growth, that flood of cash poured almost exclusively into the two biggest AI-adjacent companies, Samsung and SK Hynix. Those two tech giants grew so massive, they swallowed up 56% of the entire national stock index. Here is a visualization of how they maximized those returns. Rather than buying regular shares, investors took out personal loans to buy leveraged ETFs. These funds multiply market movements. A 1% gain magically turns into a 3% gain. But as this diagram shows, the math works exactly the same in reverse, turning a minor dip into a heavy loss. By piling massive amounts of borrowed money into just 2 tech stocks, millions of retail investors accidentally turned a major national stock exchange into a highly volatile, fragile penny stock. The fuse was lit in late June by a surprisingly small event. US-based chipmaker Micron saw a minor pre-earnings stock dip. That slight downward movement spooked Korean investors into a mild sell-off. In a normal market, a sell-off ends when people stop selling. But in a leveraged market, you don't get a choice. Look at this mechanism. When an asset bought with borrowed money drops below a specific price threshold, it triggers a margin call. The broker's computer system automatically takes over and forces a sale to protect the loan. Here is where the math gets brutal. That initial wave of forced selling pushes the market price even lower, instantly crossing the threshold for the next group of investors who bought in a little earlier. Their accounts are forcibly liquidated, driving the price down again. This downward cascade hit its climax on what Koreans are now calling Black Tuesday. Combined with leveraged funds being forced to rebalance their books, the forced liquidations drove the Kospi down 10% in a single trading session. Human panic had very little to do with it. Once the margin calls began, the selling was executed entirely by cold, automated code that simply could not stop until the math balanced out. If you look closely at the American stock market today, you'll see the exact same architectural flaws. The S&P 500 is heavily concentrated, with the top 10 tech giants now making up 36% of the entire index. Now, look at this timeline comparing margin debt across history. The borrowed money Americans use to buy stocks just hit 4.5% of GDP. That metric dwarfs every major financial bubble from 1987 to the dot-com crash to the 2008 financial crisis. And that 4.5% is likely a massive undercount. The official data only tracks traditional brokerage loans, ignoring the hidden leverage running through the system right now, like zero-day options and private credit. The American financial system has built a much larger and more top-heavy structure than South Korea's, resting entirely on a foundation of borrowed money. All this borrowed money is propped up by one specific metric, capital expenditures, or CapEx. U.S. hyperscalers like Microsoft, Meta, and Google are currently on track to spend $725 billion a year building out AI infrastructure. This creates a highly fragile ecosystem. Unprofitable AI companies justify massive CapEx spending from hyperscalers. That spending becomes revenue for chip makers, and those inflated earnings keep the entire stock market artificially elevated. But the financial math is decaying. Experts like Jim Chanos are warning that the return on this AI investment is dropping fast. The operating income hyperscalers earn on every dollar invested has fallen from 40 cents down toward a highly unsustainable 10 cents. The flashpoint will likely arrive on an ordinary earnings call, the exact moment a major U.S. tech CEO admits the returns aren't there and announces a cut in AI capex. The revenue for the entire supplier chain instantly breaks. South Korea just proved what happens to a highly leveraged, hyper-concentrated market when a single gear slips out of place. The trap is already built in Midwest market, and margin calls are waiting. Just one missing dollar of AI spending triggers the algorithm.